Welcome to our annual Real Estate Review and Forecast. I'm Tom McClocklin. I'm the president of Colliers for Saskatchewan. Just 1 year ago, on a much colder day, we were all gathered together as a real estate community, sharing knowledge, connecting with colleagues and friends, meeting new people to discuss the important issues of the day as they relate to or might impact our industry. Amazing how quickly things changed. And while we're pleased that we're able to share knowledge today, we definitely missed the opportunity to get together. It's of course the people in our business that make it the most interesting, engaging, and fun. This year, we've had to pivot our presentation format to online and considered what will be of most value to our clients and the industry at this time. Given the changes and uncertainty, we thought a deeper national perspective would provide some insights into where our future might be headed to help you navigate forward before getting into the nitty-gritty of market specifics. We're pleased to have Scott Addison, our Canadian President of Brokerage Services, join us today to give us those insights and trends in real time. Scott has been with Colliers for over 30 years, starting as an industrial agent in the Toronto region and progressing through increasing leadership responsibilities to now lead our over 450 agents across Canada and the talented team that supports them. Anecdotally, Scott was one, if not the first person I met when I joined Colliers 25 years ago. In addition to Scott, Richard Jankowski, our MD of Brokerage Services, who leads our team of over 50 professionals in Saskatchewan, will provide an overview of specific market fundamentals, future expectations, and insights. Our plan is to be complete within the hour. There's an opportunity to ask questions. Please put them in the chat box. We'll try our best to answer them real time or respond at the end as best if time permits. There's just a couple slides I'd like to talk about before I turn it over to Scott. I'd be remiss not to talk about our great team. We have over 150 Saskatchewan-based team members amongst all disciplines, including 46 agents and debt advisors, supported by our great marketing, research, and administrative professionals. We are proud to exceed 10 million square feet under management for the first time in our history. Many years ago, we set that as a goal, a BHAG as they call it, and we've been privileged to grow with our clients and help them through their ever-increasing complexity of property, facility, and asset management. This year, those complexities were accelerated to a whole new level, and we're thankful for the dedication and focus of our team had through a challenging time. One comment on our REMS platform: we made a decision a couple of years ago to press forward on significant technology investments and now run fully on the cloud with the most sophisticated platform. I made a joke to our team at a recent town hall that we're now a technology company, as it's one of our largest expense items. Our platform is robust, and there's much more we can implement from it, and we're all excited for what the future will bring. We want to be able to support our clients through all their real estate needs with the best expertise, and we continue to build on that platform through 2020 to achieve our goal. Our team in Saskatchewan delivers transactional brokerage, property management, and we have the largest team of project managers, a group who work solely for owners and tenants and are independent. One of the most exciting additions, which started in late 2019, was our debt advisory services in Saskatchewan. We all know the capital structure behind real estate is critical to its success. Saskatchewan has not had the benefit, as most markets do, of sophisticated debt analysts and placement. Our team has deep experience and credibility in this area. We've also had success bringing our national experts around workplace advisory, development management, corporate solutions, and strategy and consulting to ensure our clients are getting all the support, information, and advice to get the best possible outcome for them. All of these services are not required in every situation, but they're available when needed. One last slide is our commitment to our community. Community is very important to us at Colliers, our internal community and the communities in which we live. While 2020 required a lot of focus on our internal community, we did our best to raise much needed funds to fight insecurity and for families in need and to have a little fun doing it. COVID fun, if there is such a thing. We hope that 2022 will allow us to return to our Colliers Cup Street Hockey Tournament. We've raised over $120,000 for the Jim Pattison Children's Hospital and are now committed to helping Haven's Kids House help families in need. Scott, over to you to lead us through a national perspective.
Thanks, Tom. I really appreciate that. And I really do appreciate the hard work your group has done with local charities. And I think that's a corporate responsibility that we at Colliers take really seriously. As Tom so nicely said, been here at a long time. In fact, I've been through four economic disruptions, because I'm not sure this is a recession that we're going through. Proudly Canadian, and it's absolutely thrilled to be working for an international professional services company that's growing around the world and headquartered here in Toronto, founded in 1898. So great company to work for, and you'll see some of that. My job is to make sure I'm delivering great client services and great client experiences through our 500 agents. And that means giving them great data, information, and a platform to be able to market properties and work with clients. So that's how I see my role. Let's jump right into the trends, Tom. So some trends that we're seeing for 21 and beyond. Unequal and fragile economic rebound. This is not hitting all sectors equally. Obviously, travel, tourism, hotels, restaurants are being hit. The apparel industry, et cetera, is being hit. So it's not equal. Others are booming in the industry, technology, et cetera. There is a debate going on. Are the downtowns in the major urban centers, because of public transit, are they going to lose favor? There's been basically a 100-year urbanization trend happening in Canada where our downtowns are doing well. But the suburban office market is a hot topic now because of public transit. Industrial sector, no end in sight. I think you're experiencing that in your province as well. It is extremely strong and doing well. Retail's not dead. It's being repurposed. There's bright spots in retail, and there's some areas that have been hard hit. And then there's this section called Mind the Gap. And what I'll talk about Mind the Gap is the difference between what you're reading in the popular media, maybe what you're reading on the internet, about what's happening in the economy. And you would think that the office sector is decimated, tenants aren't paying rent, tenants aren't in the buildings, landlords are desperate. That would be what you'd read in the paper. Huge amount of sublets coming out in the market. Yet, we're not seeing a softening of asking rates. We're not seeing desperation deals, and we haven't seen a huge uptick in properties that are, I call, distressed properties. So the market's remarkably strong in that, partially because of our institutional buyers. Next slide, Tom. This slide just basically says it's not all about COVID. There's international trade wars going on. Canada's in the middle of it. We're working with the US to make sure that we can export our softwood lumber and other commodities like oil, et cetera. So we have lots of work to do. China, huge trading partner. The European, Brexit exit affects Canada. Commodities are in tough shape in oil, in particular. Canada's third largest oil company in the world. There's environmental challenges that Canada and the oil fields are facing right now. And Biden-Harris has not been favorable so far to Canada in canceling some pipelines, and their environmental policies could affect our economy in a negative way. So it's not all about COVID. There are some other headwinds hitting the sector. Really quickly getting into rent collection is a really good story. Immediately at the start of COVID, we saw the market as being, it was like, oh my God, what's going to happen? People aren't going to pay rent. There was movements that you saw in the media again, getting tenants in multifamily not to pay. Retail won't be paying, but it has rebounded really strongly, and they're back up almost at pre-COVID numbers of rent collection. That doesn't mean there aren't some arrears, and that doesn't mean that there aren't some new rental agreements that have been agreed to. But this is really reflecting what's happening in contractual rent in all asset classes. It is a good story. Is it government money that's propping this up? We will see in the future. Asset classes, investment volumes, so we're going back different categories, but what you're seeing on this screen is obviously 2020, we saw investment volume in all major cities drop significantly. No surprise there, as the institutions largely stayed on the sidelines because of the uncertainty. Where's everything going? The other change is multifamily has become the darling of REITs and institutions. Private families are selling out. Nice stable asset. Our population is certainly stabilized, and we'll go back to immigration that drives that, and the trend of industrial becoming an institutional favorite is continuing. So you're seeing more industrial sales, more multifamily. Retail remained relatively active. Some of that is sales for repurposing, and others is there's people that are seeing retail as it's not going away. People are still going to shop and buy. It may be differently. The big drop has been in office where people have uncertainty. These graphs are interesting too. On your left-hand side, 2009, great financial meltdown. People were very worried. It shows the risk factor. This is really the difference between the 10-year government bonds and cap rates, 4.35. The risk factor is actually larger right now. So it's factored in despite the fact that cap rates are down lower. We expect to see a bit of a narrowing of that gap, and we're already seeing it. If I could probably put today's numbers in, I think you're going to be down around that 4.35. So there's risk factored into these low cap rates when you look at the difference between bond rates. That's the message here. So people say, well, how can the cap rates go down in COVID? The risk factor has widened. Diving into office a little bit, lots of factors in office. Work from home is certainly one of them. It will be here. We're going to see more flexibility. I think that's becoming more and more obvious, but I don't think we're going to see 80% of our work population working from home. And there's a variety of reasons for that. Before COVID hit, there was already a detensification. So this swing of less office space per person was starting to turn and go back up the other way. So those are two factors that are hitting. There's been an urban exodus. So this is long-term. It's just been accelerated in COVID. Before, downtown centers were popular among young people. That's the pink in the graph. Even young people are moving out of downtown cores now, and they're finding they can work remotely from urban secondary properties or other properties. So that trend's continued. Why do our city centers still thrive? We have huge immigration in Canada. That drives a lot of that. I'm going to talk a little bit about occupancy. In the graph on the right-hand side, top right-hand side, just shows up right now, about 20% of the workforce is in offices, and that's the COVID effect. We expect that to bounce back pretty strongly and probably be somewhere around 85% of people back in the office. Big factor, wellness. People are concerned about air quality and cleanliness of the buildings, and you're going to hear some international standards on wellness of buildings, etc. Collaboration space in office is huge, and it's going to get bigger and bigger. And the other trend is people go to offices because of the amenities in the ground floors and the amenities that are offered. That's one of the reasons people like working in offices. We've lost a lot of those through COVID. We're going to have to rethink and redo that, but landlords are going to need good amenities in their buildings. We see those trends moving forward. Next slide. I talked on this a bit. I won't talk a bit much more. This is just the occupancy in office throughout North America right now, about 20%. We are seeing a difference in urban centers in Canada. Suburban offices are got about 30% occupancy, downtown 10% in Toronto, Montreal, and Vancouver. This graph, really quickly, 100 was the amount of space that the average employee got. So it's not 100 square feet. It was, that's ground zero, and it can go up or down. We've seen a 20-year trend of office space per full-time employee getting smaller and smaller. We would have predicted a year ago that was going to start increasing as detensification started happening, and detensification was happening because corporations were learning that their illness rate, their absentee rate, their stress rates, and their lack of ability to focus were all affecting them, And the HR departments were saying, we need to give people more space in office buildings. When you go into some of the call centers, really dense spaces where they're down to about 120 feet per full-time employee, it was too dense. However, work from home is going to have a negative effect. So you're still going to see a trend of downward space in amount of space per full-time employee in the long run. Tom, next slide. This is a good news story as well. This survey on the left-hand side simply shows how many people thought that they would need less space because of moving forward, how many would stay the same. So dark blue is less space, light blue was they would keep the same amount of space. And we've seen over a 6-month period, people are starting to say, I think we're going to end up keeping the same amount of space. And the amount of people thinking they need less is decreased. And the other bright spot you see crammed down at the bottom of the chart, 4% of corporations now think they're going to actually take more space when they come back after COVID. That was unheard of 10 months ago. So you're starting to see a really rapid shift. Work from home isn't working. We're going to need the same amount of space. Well, maybe we'll need more space when we come back. There's still a big percentage thinking less space. Why is that? The red graph on the red portion of the pie graph on your right simply shows what's called high friction in the digital world. High friction is when you're sitting on your Zoom call and you're getting, people are freezing, the voices are disappearing, and people are dropping off and dropping. As our internet, the backbone of our internet gets overwhelmed with everybody working from home and doing presentations from home, a lot more digital friction. They were willing to go through it for a few months as we went through COVID, but there's real fatigue with it. People want back in the office. That's one of the key reasons. The other is people like to be around each other and have friction. So we see real positive trend back to the office in the future. So office, there's lots of factors that should show you increased space, detensification, collaborative, more space for retreat and wellness space, more air around people and lunchrooms within spaces. Space decrease, work from home. A lot of people thinking that their employees are going to work at least 2 days a week from home. They'll have the flexibility. That doesn't mean they're losing the office. That doesn't mean you can instantly turn into hoteling. It's a process to be able to put a company through hoteling and non-assigned seating. You can't just flip the switch overnight and doing that. So we think it's a 2-year process for most companies to get there with their technology and their knowledge. Space neutral, there's a lot of factors that are sort of keeping space the same, but employee experience is still there. It is in Canada still hard to recruit the right people, and you've got to have nice space for them. And that's one of our key messages out to tenants and landlords in the market. Office fundamentals. Remarkably strong, as I said earlier. If you look at this graph, a lot of positives in it across the major cities in Canada. Vacancy rates, if we had to go into this disruption last March 11th, I think it was, as we did, we were in a super strong position in office. Across Canada, we had extremely low vacancy rates, historic lows. Our advisors were complaining that they couldn't find space in most of the major cities. If you had a large tenant, you couldn't find the right block of space. So rents were high, landlords are well financed, it's largely institutional loans, so they can go through a disruption. That's why there's not panic in the market. That message has to get out. The red box is Edmonton and Calgary, higher vacancy rates, problem in the oil and gas industry mainly, but the bright spots in Calgary and Edmonton, especially in Calgary, we're starting to see tech companies move in there, and we're starting to see some growth from that side. And there's, the Globe and Mail had a 500 person employer locating into Calgary. So takeaways. Technology is a driver of huge demand. Canada is growing our technology employment. but that same technology is keeping people out of the office and allowing the mobility to and work from home. So there's a plus and negative to technology from the office perspective. Workplace strategy, work from home versus detensification and growing the amount of space per person. The fundamentals are really strong across Canada. You're hearing about a huge amount of sublets that coming flooding the market in some of the major cities, and that hit all the newspapers. But when you really dig into it, the corporations that are bringing these out want to recover full price. In Toronto, we're seeing from head lease or current market to any of the sublets done a 15% discount. That's it. We've also seen some companies once they start getting offers and seeing how low they are, just taking the space back off the market. So I think this sublet, the amount of sublet coming on isn't as big as it sounds. For one, it might take a market that had 2% vacancy to a 4%, still really a strong market. So sublet, I think is overtalked out there in the market, and it's not such a huge discount. We are seeing the flight to quality. New buildings, people are moving into new buildings, and old buildings certainly start looking at improving HVAC and anything you can for cleanliness and air quality in the building and amenities within the building. Take a serious look at that, and you will retain your tenants. Next slide, Tom. Industrial. As Tom pointed out, my background, buy land, they're not making anymore. Canada's a huge country though. So what it's really about is serviced land that you can bring on stream and start building on in the future. We have extremely low vacancy rates all across Canada in industrial, and we're not building fast enough. That's because it takes a long time to service land, get it through the approvals, and get it ready to build. So there's lots of land in Canada. There's not a lot of service ready to go land. Costs for industrial are dramatically rising faster than inflation, whether that's transportation, whether that's net rents, whether that's land costs or labor, all rising pretty significantly in Canada right now. So that's affecting our industrial product. You've heard a few stories about multi-story industrial. The two biggest that I know of, Oxford's building a 2-story warehouse in Vancouver, obviously land constrained market there. And in Ottawa, Ontario, Amazon's building a 5-story industrial building for their distribution, last mile distribution. Those I think are going to be anomalies in Canada. You will see higher clear heights, and I'll get into that a bit more in the future. Amazon, everybody talks about Amazon, 11 million square feet in Canada. They're talking about taking 20 million additional next year. It is changing the market, but it's not just Amazon. It's the Walmarts of the world. It's the Sobeys of the world. It's Canadian Tire. Every one of them is building new industrial distribution centers in multiple markets across Canada. And we're seeing clear heights in those buildings up to 100 feet, fully robotics. In those buildings with full robotics, very few employees in many of these high volume centers. And if you get an opportunity to go through one, you should. It's fascinating. Green line here is this is just showing the cost of logistics services, etc. But the green line is couriers and package delivery. That is an effective e-commerce. And if you've been at home during the day, you've seen packages being delivered to all your neighbors' houses and likely your own from Amazon. The amount of cardboard we're using must be dramatically up as well, but it's had a huge effect. So transportation costs are rising much faster than inflation. So are hourly wages. This graph just shows you the dark blue is hourly wage increase in dollars per hour. And strongly outpacing inflation. So it is still hard to find workers. So when I say we're going through an economic disruption, we're not in a recession in Canada. It's completely different than anything we've seen in the past. Tom, next slide. Industrial fundamentals. Edmonton, Calgary struggling a little bit compared to the rest of the country. Rental rates dramatically increasing. There's a mismatch between the amount of space coming online and the demand. The demand is increasing faster than we're building space. We are a very cautious economy in Canada when you compare it to the US. I had a trip to Chicago in 2019 and toured some industrial buildings. They were building 14 buildings over 700,000 square feet in Chicago. And they had an 11% vacancy at the time. In Toronto, the market's smaller, but we were only building 2 buildings over 500,000 square feet, and we had a 1.5% vacancy. So we're very cautious. We're not building enough, and there's huge demand on the industrial side. And lease rates are going up dramatically. That's what this slide shows. Industrial vacancy is largely trending down. Edmonton's trending up a bit, largely because the oil and gas, as they call them, the sheds, the machine shops are showing that increase, but really a good picture for industrial. Amazing thing on the industrial net asking rates. Toronto had this unusually low industrial asking rate. When you look at the price of the land and what it would cost to build a building in Toronto, we were getting rents in the $4 to $6 range. And all of a sudden it started shooting up and catching up to the rest of the country. You know, I'd go to some of the other cities, and they were getting $9 and $10, and Toronto's at $6. And that kind of doesn't make sense. Maybe there's less, you need less of a return because there's less risk in Toronto, but it didn't factor out. We've seen a huge increase in the Toronto rents. We are worried that'll push distribution to other centers of the country. National industrial outlook, vacancy is going to be dropping. We're not building enough. I think, redundant to what I said earlier, but we are seeing clear heights go up and up and up, and that's driven by the e-commerce and automation. Technology is changing. It's not just the technology you may have in your office, it's in the warehouse. Tow motors can go higher. Robotics are working. There's stacking and racking that goes higher and higher, and there's new conveyor systems so we're seeing Walmart. We did a transaction, 600,000 square feet, expandable up to 1.1 million square feet, 90-foot clear building. That is not unusual in Toronto now to see specific built buildings. Canadian Tires, 60 feet. They've got another building that's got 100-foot clear, totally automated. So that clear height's just soaring, automation soaring. Employment numbers are starting to come down in certain sectors too because of this automation, manufacturing in particular. Land, nobody's making any more, nobody's really servicing enough is probably really the story there, and rising costs in industrial. So be pushing inflation. Retail's not dead. Retail's changing. So this really looks at retail sales volume in Canada, and you can see in the Great Financial Meltdown, we had a hiccup there. It went down. It took really 2 years to recover. We're seeing the same thing, but look at the dramatic change. And if we set our minds back to about a year ago, 11 months ago, I think everybody was really worried that we're locked down in our houses, something many of us had never experienced in our lives. Told you can't travel, spending dropped. People were really worried that the recession, then the government stepped in with some pretty massive money, rightfully so, to make sure the economy stayed on the right path, and consumer confidence and spending has started moving up pretty dramatically. But we don't think it'll return to second quarter of 2024. So consumer confidence is always a great indicator of how people are going to spend their money. And 2009, after the meltdown, it was at all-time lows. Well, the pandemic drove it considerably lower than that. And we've heard about the rebounds of consumer confidence. One poll will tell you it's only rebounded to where we were at the bottom of 2009. But there's Bloomberg didn't believe it, so they've started doing their own consumer confidence poll, and it shows it's actually much stronger. So a little bit of a conflicting message there. I'm with Bloomberg. People are spending money. Where are they spending it? Retail is undergoing change. Obviously, gas stations and auto repairs way down. Clothing and accessories way down because people aren't buying business suits, aren't buying ties, a lot less spending, aren't going out to fancy restaurants, etc. So consumers are spending down. But when you look at things like home and garden and building materials, etc., electronics, way up. So retail is, you can't say retail in general has been hurt. It's just being spent differently. Sporting goods, hobbies, books, and music. Interesting, it's down. You know, people are at home, but you can't do a lot of the sports right now. And apparently they're having huge supply chain problems in that sector. And I think if you tried to order a Peloton, you'd find out it's a 10 to 12 week delivery time. So lots of things changing in retail. I said retail is changing. If you go to any mall, you'll notice there's more vacancy. Why is that? E-commerce is definitely growing. And to give you some context on this, Canada has typically been a laggard in using e-commerce, buying through Amazon or whoever. The US is about 15% of retail sales is e-commerce now. Through the pandemic, as we've gone into lockdowns, we've seen the Canadian experience soar. It's gone way up, and then as the stores are reopened, it drops down, but it doesn't drop down to the low level we were at. We keep gaining, people get comfortable with e-commerce. It is a factor, and we do see it in Canada moving up closer to the US number, which is about 15% of all retail sales will be done by e-commerce. That's why this graph is accurate. This is different regions of the country showing where we think retail vacancy is going, and it's going up. And that means it's going up. Retail, we're seeing repurposing, we're seeing some tear down, we're seeing some retail being changed to things like post-secondary education, medical uses, and being repurposed to mixed use facilities. And we're seeing quite a bit of that in Toronto and Vancouver. So we think that trend will continue, but vacancy will still go up for what remains of retail. So retail outlet, really there's a lot of pain out there in retail, and there's no gain for the bricks and mortars retailer that we've seen immediately. There are some winners out there, but on the bricks and mortar side of it, not enough. The e-commerce side is huge winner. It's a trend that's going to stay and continue to grow. It's not enough to be just clean. You have to actually draw people into your malls, and you've got to prove to people if they're going to come back into the malls, it's going to be safe. There's a huge fear factor out there, and legitimately so, from a big portion of our population. And new buildings, you better embrace the new technology, the shopper experience that helps people find what they need as they walk through your malls. This is largely digital and wireless. Tells them, hey, you were on the internet looking for jeans last week. While you're here looking for shoes, you might want to look for jeans, and here's the Levi's store, etc. And we're seeing a lot of that building technology and helping parking, etc. So the trends: unequal rebound, downtown, suburban there's a resurgence of suburban office, industrial is extremely strong, retail repurposing, bright spots though, there's money to be made for value add people in that. And the story's got to be told that landlords aren't in a position where they're desperate. There's no distress, there's not a huge amount of distressed sales. Is that, how long can they hold? We'll see. I really wanted to, we've been on a long journey of making sure that Colliers has great data and able to present it, going back 10 years, really ramping it up in the last 3 years. And I wanted to thank some people here. We hired a new director of research, national, who put a lot of this slides together. He has like 1,000 slides that we could share that are interesting. And he does a far better job of this than I do. So maybe next year we'll have him as well. And I'd like to thank Rosemary, Wendy, and Brendan locally for helping out bring all this together. It's great work. We're investing heavily in data and research to help our clients make the wise decision. So, Tom, I'll turn it back to you.
Thanks so much, Scott. Over to you, Richard, to talk about
Yes.
in an area.
Have that finger ready, Tom. We're going to be tight here. We're going to go hard. So, Scott, thanks a lot for that overview, and lots of questions in the panel box already about what's going on in Saskatchewan. In normal times, we watch what's going on with the trends. So this is what we need. As well, the shout out to our research team, and we've built a new team just on the data side. We're tracking 80 million square feet in our province, and obviously the accuracy and the ability to inform clients is based on the success of our team. So Rose, Wendy, and Brendan have joined. We've got backgrounds in computer science, business, project management, and data analytics with our new team. I also want to acknowledge and just build on Tom's comments about the depth and breadth and strength of our sales and administrative team. In excess of 600 years of business and real estate expertise in Saskatchewan, the bulk of it in Saskatoon, and of that amount in the province, 450 years of experience, commitment to Colliers and our clients. As well, the debt advisory team, right at this point, the largest team in Canada, providing that service to our clients. Soka, Peter, Dallas, and Brad and Tanis. So you'll hear more about them in the future. Jumping into headlines. So what was in the news in Saskatoon in 2020? Definitely the COVID blanket, the COVID news blanketed us. It was at the eye of the storm. And yes, we keep hearing that this is a health crisis, but and not an economic crisis, but definitely the challenges are out there. Air travel, hotels, restaurants have faced this head on. On the upside, we discovered the staycation. Had a chance to do that myself this winter. We aren't immune to the fragile economic expansion trend that Scott mentioned, but I would suggest that we're in a position to rebound as quicker than any jurisdiction in Canada, given our diversified economy and export growth outside of North America. And Scott, 45% or just under 45% of Canada's arable land is out here, so bring on the food and energy. In terms of building permits, COVID's impact did spread over the permits last year. Commercial permits dropped. In fact, they've dropped in the last couple of years from 228 million to 82 million. So that's a 64% decline. Meanwhile, there's been a huge lift in the residential permits, as you can see, and pretty much on par for the average of the last 6 years. So not surprisingly, a boom there. Going forward, aside from public sector debt, supply chain problems will impact the construction industry. That could affect all types of programs that drive construction projects. The fact is, we just don't know how far that's going to go and how precise of an impact it'll be. But government stimulus programs for infrastructure will be a story for years to come. Let's not again forget about our land base and resource sector. So drilling down into the asset classes for Saskatoon, first of all, in the office market, the downtown office market has grown, and we're at presently at 3.2 million square feet now that River Landing's East Tower has come on stream. We're seeing a significant increase in vacancy due to tenant repositioning in the central business district. And actually that trend started a while ago. So the driver recently is River Landing, which represents roughly 13% of all of the inventory downtown and 7% of the overall market in Saskatoon. So as it's added and comes on stream, the effect is going to be quite deep. Next wave is that'll pass through, that will occur as Nutrient Tower, slated for completion this year. Meanwhile, our downtown vacancy is up to just under 18%, and we expect it to increase to low to mid 20s before retracting. Again, it's reasonable to expect that as larger blocks come on, there's going to be negative absorption because of lateral movement with tenants. Obviously, that trend, the trend we'd all like to see accelerate is space getting gobbled up through growth. So we'll wait and see what happens with post-COVID. Suburban, a little bit more positive here. Suburban vacancy has increased to just under 14% with about 260,000 feet of space that's come on and been brought to the market in the past couple of years. Meanwhile, the reality is we're positioned to grow and diversify in this submarket if that national hub and spoke model or trend that Scott talked about emerges here. In terms of flight to quality, this started long before the pandemic and is definitely, you take a look at the Class A market, there are tough times for that subclass. So the move up from C to B and B to A is expected. Landlords are also expected to become more aggressive with inducements to attract potential tenants. We're seeing tenants explore short-term leases while repositioning or postponing real estate decisions altogether. One of the more overlooked competitive advantage I find in Saskatoon and its office market is the even distribution of space between the downtown and the suburbs. About 52% of the space is downtown of the 6.1 million square feet in total, and 48% is outside. So that's essentially bang on with markets our size in Canada, where you can actually live, work, and play in the downtown. It's good news for the city, and it's a competitive advantage for us. Taking a look at rates, downtown pressure and net asking rates is expected in a rising vacancy rate environment. So far, there hasn't been a big change on asking rates. We definitely haven't seen the net asking, net effective rates of 0 that Calgary is expected or experiencing, but single digits are out there. The challenge is coming, as I mentioned, for B and C class product. Overall rates are still very competitive for the Prairie region, which is a positive for us when we compete for tenants. But the disruptor for 21 and likely going forward, we expect will be Calgary, especially that tech sector market that you mentioned. Taking a look at notable transactions, a little bit of a softer market last year for sure, but there's a few to point out. On 8th Street, Circle Center Tower, McFall Financial expanded their operation into 7,800 square feet. 880 Broadway, that's a new development, which is always nice to see. Lingard and Drager, an accounting firm, is expanding into 7,300 feet. First Avenue North, the Commissionaires moved into a suburban location in downtown. It's not something we normally, or something that we've seen in a while or last couple of years. And 4th Avenue South, a significant renewal with the Department of Justice and the First Nation Bank. Pretty solid rental rates there. And if we're talking recent news, the bigger news locally is Campotex moving into River Landing's East Tower later this year. Words of wisdom, we wanted to share a few things for landlords, tenants, and investors. From a landlord's perspective, taking a long view, working with a trusted and informed team, obviously focusing on a blend of creativity and retention. For tenants, yeah, it's a soft market. There's options out there. Seek out and understand those. Consider a plan that addresses as well employee retention and return to office. And last, on investors, just understanding the evolution of the market, leaving no stone unturned. There's nuggets to be had at some point. Now, industrial. So let's take a look at the supply, absorption, and vacancy. This Saskatoon has a great industrial market, really. It performs well and is a key driver of recovery and growth. Vacancy has been in a decline for the past few years and now sitting at 5.4% as limited new inventory has been brought to market. We feel the market went through a transition in the past couple of years and actually was ready to take off when the pandemic came along, which slowed us down a little bit. But when you think back to Scott's national data slides on this asset class, we should be very optimistic. A couple of reasons. Toronto's net rates are on par with Saskatoon for the first time. On top of that, we have very favorable business tax structure. Labor supply is stable to good, and service land is plentiful. And Scott, when we're talking about the challenges in Toronto with the distribution of space, we can think of lots of places out here to put that. So not all markets can say what we have to say in that regard. The challenges are going to be likely lumped into three groups: supply chain with material shortage and construction cost increase, competing with Alberta for prairie region business, and our resource sector setbacks that we've had. Now, net asking rates and sale prices, they have gradually increased in the past few years, sitting at 10.18 right now. The drop in new supply, as I mentioned, and lower vacancy rates suggests is likely to hold or even to trend upwards for 2021 and beyond. With limited new development and low vacancy offset by some casualties of the pandemic, rental rates, though, shouldn't jump a lot. Sales activity is likely to stay hot in the coming year. And in 2020, the sales prices ranged from as low as $92, just under 93 per square foot for older warehouses product, to as high as $275 per square foot for industrial condos. So the average price being $165 per square foot on product. Land sales were down last year, a trend we think will reverse this year and next. In fact, there's a fair bit of activity in the go right now. In Saskatoon last year, there were 9 parcels sold at an average price per acre of $495. It's actually quite well below the heyday of 2018, when average prices ranged around that $633 an acre. And let's not forget that there were pre-COVID challenges to the economy, but pending the vaccine, the need for resources, strong business and development community, all of these bode well for things going forward with land sales. If you don't, we're not making any more land, as was noted. Notables: 302 Melville, leased to buy original. 814 60th. There was a couple of transactions here. The first was a subdivision on just over 3 acres of land, which sold to a Winnipeg investor, White Land Services. The second part of that was a build-to-suit lease with Ken Parlumas for 30,000 square feet. Great deal. McKee Avenue, that was sublet to GMR, interestingly, at a rate in excess of the head lease. 1502 Quebec Avenue, a renewal for DK Pallet, again confirming that there's confidence in our market in the long term. So words of wisdom for the industrial sector. If for landlords looking after your tenants, understanding the nature of your tenants' businesses and their economic challenges. Again, it's always a partnership between landlord and tenant. So be prepared to invest or reinvest. There's a market differential in quality, but things like lighting and systems and so on. From a tenant standpoint, understanding the supply chain impact to your business. Government programs have helped everybody out, so staying on top of those is key. And if you've got challenges, please be real and have a good, deep talk with your landlord. Investor side, watch for things to change as we go through the cycle. Cap rate compression will continue because of the limited deals out there, so you have to be ready. And we do feel that there's opportunities to build in that 10 to 20,000 feet of product and get some of that out there. I'll move into the retail market now. Thanks, Tom. And mention that there's no surprise that 2020 was a tough year for this asset class. The fallout of the pandemic isn't over, so there's more to come as far as its full impact. This coming year is going to yield trying times for certain categories of retailers, not just the ones that Scott mentioned. And there's going to be business closures, some of which have already occurred, which is going to drive vacancy up. The drop in new inventory, though, from a traditional about 250,000 square feet to just over 82,000 should help. So that's the negative news. But overall, the current 5.7% vacancy really isn't that bad. We're just used to lower numbers here. On the upside, this sector is creative and it's resilient. It reacts quickly. It's got the support and the understanding of government programs. They've done their job. They continue to do that. So the reallocation of consumer spending from travel as well should help this industry. Once we get out of the pandemic, it'll reinvent itself. So the operative words here seem to be hang on. So looking at a distribution of space with future and recent developments, most of the retail development continues to be focused on the east and northeast sectors of the city, specifically in and around Brighton and Evergreen. There's still a few infill developments that are continuing, and all are having success in leasing, albeit a bit slower through the pandemic. Now, there's no other major developments planned in the near future, and likely will need to wait until the economy stabilizes before developers take on a major play. But you can see well distributed and ready for growth of the city. From a rate standpoint, the newer product obviously is going to continue to drive demand higher on the rate side, especially given the quality and the all-in cost of construction between materials and development costs. All of the suburban centers that have been built out in the last 5 years are commanding rates of that in and around 30 and higher, $30 a square foot net, while 8th Street remains our prominent retail corridor and commands strong asking rates. It's holding its own. Newsworthy trends. Well, Skip the Dishes, Uber Eats, DoorDash, all these third-party apps have dominated the food delivery market and impacted that industry, good or bad. David's Tea, La Senza, Aldo, Mec, these companies have hit on hard times. There's numerous others. The last national retail report I saw was in excess of 24 that are on the rope, so to speak. So they are in trouble. But there is positive news. Again, part of the creativity of this industry. F45 opening its third location on Slimmen Road. OEB opened River Landing. Chop Steakhouse in the South End in Stonebridge opened in the middle of a pandemic. And then Sephora announced the largest store expansion in its 21-year history. So trends, it's all about food and fitness. Really, local craft brewers, places like Prairie Sun, Better Brother Brewing leading the way. Niche fitness studios like Local Bar, Peak Crew Roadhouse, and F45. Those are disrupting the fitness industry with smaller spaces, less equipment, which means lower startup costs, obviously more tailored workouts to boot. Those are, and they're charging more, so they're good. They're mainly targeted at millennials. So a real trend to watch going forward. One trend that isn't new, but is really dominating, the cannabis boom. In September of 2020, our provincial regulator, SLGA, or Saskatchewan Liquor and Gaming Authority, removed the cap on the number of cannabis retail stores permitted to operate in the province. We now have a system that allows cannabis companies to manage their distribution and supply. These companies are pushing the envelope to change the stigma about their place in the retail economy, quite frankly. They pay premium rates for their space, and they'll be part of the future, especially as new science, new products, supply chain solutions, and social acceptance increases. So what is the real solution for the retail market? Well, a proper and effective supply and distribution for vaccines. The world has really issued a call to action on vaccines, which is great, with 2 or more new ones coming out in the past week. The government of Saskatchewan indicated as well this week that we will all be vaccinated by June. Fingers crossed on that one. So notable transactions in the retail market. Again, a slower year, and with churn for sure, as I mentioned. 1110 Grosvenor, the former Keg, plans there to repurpose from a restaurant, may become a competitor to the next Grosvenor site, the location of the long-serving Jerry's, which is now a Market of Asia operation. 1713 Preston, for FXR, an Adrenaline Limited, who relocated from the North Industrial area. 149 Kensington, the home of another new Leopold's, their 4th location in Saskatoon, 15th in Canada. There's been a fair bit of business exit 8th Street as well. Original Joe's, Mr. Mike's, Keg, Milestones, Pickled Beans. So lots of change in that area of the city. Let's talk about the words of wisdom here. Staying on top of the government programs. As I mentioned, staying positive for landlords. Positivity is key. And understanding your tenant's business, this whole partnership thing, that the tenants digging into support programs and actually having a good business plan to stay nimble and be real when talking with the landlord, just laying it out there. This asset class is also going through a change. There's lots of opportunities and challenges for investors because of the landscape changes so quickly. So monitoring the movement for sure. Last but not least, investment in multifamily. This slide shows a range of cap rates from last year. There are swings in most asset classes, so you really need to understand the story behind the cap rates. There's a lot of deep dive required. Deal velocity was down, but we are seeing a couple trends on those cap rates. And first, as always, it seems there's a shortage of product, but secondly, quality. Quality, covenant, and vacancy played a larger role in the past due to the pandemic and the perceived market risk out there. We take a look at transactions by asset class, as would be expected. In investment volumes were down significantly from 2019. Industrial multifamily properties, similar to that national trend, Scott, continued to see the greatest market performance, and we expect that to continue in 21 and 22. In terms of multifamily trades, price ranges in the past year have been quite extreme, again, based on the wide range of product in the market. Even regardless, demand is up. So bottom pricing of just over 94,000 per door to highs of 193,000 per door is an indicator of that. We don't see the trend changing. Our market's all about wide gaps in quality. So there is higher new end product in the market, which is driving the pricing at the top end of the range. People will pay. Notable transactions, we thought we'd share a broader perspective for the province. Elkridge, just kicking that one off, this province's only 5-star resort and conference center. It sold to a local group, and which we're happy to see, and it's getting back on its feet. Wanuskewin, that was a sale leaseback involving Norseman Industries, their flagship, and the city of Saskatoon for $15 million. Cope Crescent, this is an example of multifamily demand where there's commercial space, selling for $34 million to a BC-based fund at just over a 5 cap, and 2301 St. Henry, which sold for just under $2 million or just under $114,000 a door. These two transactions demonstrate the value difference between older and newer product. Last slide on notables. The Phoenix building on 20th Street sold for just under $7 million at a cap rate of 6.17. This transaction required a very creative deal structure and was one of the first major deals completed during COVID. The Colonial Hotel and Retail Complex sold for $13.25 million on 8th Street. It was one of the very few hospitality transactions to complete during the pandemic. Tough market there. 2020 St. Patrick cold storage facility with a redevelopment potential sold for $3.8 million at a 7.33 cap rate. And last one, 8th Street, sold for $12.75 million. So that's the notables. I'm going to eventually stop to take a breath, but that's it for the quick market overview for Saskatchewan. I want to thank you for your time and attention, and we want to spend a few minutes at this time just getting a feedback from you. You've got a few survey questions, and Julie, if you can fire those up, we'll get into them. There's no logging on. It's simply multiple choice here. So for the crowd and the attendees, we're asking how long do you think it'll take for the economic recovery to occur in Saskatchewan? 6, 12, 24 months or longer? We'll see how this compares with Regina's responses yesterday. Survey says
12 months.
12 to 24 months. That is essentially bang on. We had an 80-20 rule with Regina. So there you go. Next question. What percentage of people will continue to work from home post-pandemic? be interesting to see how this compares with
Scott gave his,
yeah.
he was clear on what he thought.
Scott, what was that again?
Oh, I think you're muted.
Sorry, you're muted.
I don't want to lead the audience here, but I did say, we'll see if they were listening at that point.
Yeah, it's not a test.
Yeah.
We can buck national trends. There you go.
Yeah.
25.
Well, 15 is what I said. So
Yeah.
Yeah. Low. I mean, it's interesting. People think it's a low percentage, which I would agree with. That will continue. Flexibility might be, but
yeah, I think that it's confusing. People will have more flexibility going forward. I think we've proven we can work from home, but is it sustainable to always work from home? I just don't think so. For most jobs.
Folks, overall, where do you see rental rates headed in the next year in the province? It's a tough one because there's so many different stories within the asset classes.
oh,
Here we go. Survey says
no change.
no change.
More pretty significant group of higher. 20%. That's
Yeah.
positive.
Industrial property owners.
Yes.
What is your 1 to 3 investment outlook for real estate in the province? Positive, negative, neutral, uncertain.
It's a real estate group. We're all positive, aren't we?
Optimism, right? Why would you get into the industry if you're not optimistic?
Yeah.
Especially brokerage. We'll hire you, but we're not going to pay you anything. You better be optimistic.
See if we led them. There we go.
Yeah, we led them.
Oh,
Yeah.
nice. Nice. And now for the most important, this one's really for you, Scott, I think, but this is a key question. We got to get this one right.
I've got an absolutely. The Argos won't win it.
Yeah, there you go.
The Leafs have a better chance of winning the cup than the Argos winning the Grey Cup. So,
always love the optimistic Torontonian when partway through.
Yeah.
I can get you all seats at the Argo game, though. I can probably afford to buy for everybody too.
Well, we're wrapping up this last question, which it has to be yes. So there we go. There's the optimism of the group. Just want to thank you both, Scott and Richard, for your comments and participating today. Really appreciate it. And thank you to everybody for taking the time to join us this morning. Again, we wish we could have met face to face and had a chance to catch up. It's one of the great things about the industry, as I mentioned. And thank you to all of our clients, all the people that we work with during the year. And we really think we're going to come out of this in 2021. And we think that there'll be quite a good economic recovery. And so we look forward to working with you again throughout the year in the future. So wish you all the best. We, of course, if there's anything we can help with or further information regarding this presentation, we'll look at the questions. If any aren't responded to or we can get back to you, we will do that over the next few days. And we'll also send out a copy of the presentation and a link to everybody and also post on social media. So thank you very much on behalf of all of us at Colliers, and have a great day and have a great year ahead.